Holy shit, what is happening to the global banking system? So what's playing out so far is actually a pretty standard credit cycle. Credit cycles tend to follow a fairly standardized script. And when I refer to a credit cycle, I mean the boom and bust really of the debt market over time. So it typically begins with economic expansion, which turns into an economic and asset price boom as people overreact. Inflation will move above the Fed's target at this point. So they'll start to get worried about inflation. They'll start raising rates. They're so data dependent that their rate hikes always tend to lag. So the Fed keeps raising rates far into a credit cycle. The yield curve typically inverts. That means that short rates tend to flatten relative to long rates. And then the Fed stays tight even as inflation data remains sort of sticky. Consumers actually borrow at this point to make up for lost income in other sectors as some of the economy starts to slow. This is when lending standards surge, as banks start to tighten credit. This is the part that we're at right now. The economy slows as expansion of credit erodes, and then a recession ensues. And then the Fed wakes up to reality, they cut rates, and the cycle starts over. The part of this cycle that most hurts banks is the rate hike increases, which invert the yield curve, thereby making it more difficult for them to borrow short and lend long, but also the way that interest rates negatively impact asset prices. The global bond market was a $115 trillion market before the Fed started raising rates. So when rates went from 0 to 5% inside of 1 year, they caused a $15 trillion loss in aggregate. Of that, almost $700 billion was held by banks. The interesting thing about what's going on now is that most of these losses are in government bonds, so they're temporary, which makes this very different from something like the financial crisis where banks held a legitimate amount of absolute garbage. Banks are in much better condition than they were in the financial crisis, and that's best seen in the reserve coverage ratio, where you can see that banks are actually holding a huge amount of reserves relative to their current loan losses. So banks are in much better condition than they were in 2008, but the collapse of Silicon Valley Bank exposed an uncomfortable reality. There's $18 trillion of total deposits in the US banking system. Only $10 trillion of those deposits are actually insured by the FDIC. And so what that means is that if a lot of these smaller banks actually needed to convert these deposits, they'd have to realize very large losses on their bond portfolios, and that would probably render them insolvent. So perception is reality here, and even though a lot of these banks aren't technically insolvent, they could become insolvent simply because people are asking the question, what if my bank becomes insolvent? So the last 3 years have been this crazy roller coaster ride where COVID happens, you get this huge amount of government spending, the Fed stays easy for too long, then they jack up rates really quickly in 2022, causing huge amounts of bond losses and asset price declines. Now people are realizing their banks may or may not be solvent, and making matters worse is people are sitting around wondering, looking at all these small regional banks saying, hey, why am I keeping my money there when I know that the government seems to only support these 8 really large banks? And that's why the US banking system is as mucked up as it is at present. Thanks for watching, everyone. I hope you learned something new. I'll catch you next time.